All right, welcome to Benny and the Squirrel. It's April 30th. Today we are joined by my old grad school buddy and colleague, Adam Peck of Riverwater Investments. He's the CIO, and he also has had the joy of running their small cap fund. So welcome to Benny and the Squirrel, Adam.
Thanks for having me, guys.
Adam, so you have ran small caps for how long?
Too long, 20 plus years.
So basically since we finished grad school, more or less, right?
Yeah, I mean, my claim to fame is we finished grad school in 2006. I interned for a small cap firm called Heartland Advisors in 2005, and that represented the peak of the small cap cycle at that point. So since I've been in small caps as a professional, it's been a wrong way trade. But I think we'll get into it. I think everything is inherently cyclical, and small caps will one day have their day, and I think that's coming up soon.
Yeah, well, you're the small cap. We've talked about it a bit. So I guess we can start by just kind of talking about, what kind of style you have for our listeners who don't know who you are, what your investment philosophy is, and how you've dealt with 20 years of pain.
Sure. And the 20 years of pain, for everyone to realize it's relative pain to large cap growth. We've compounded our investors' capital at double-digit rates, so they're not unhappy with us. And we've beaten our benchmarks by a wide margin with betas substantially below the benchmarks. So on a risk-adjusted basis, I'm pretty proud of our record. But at the end of the day, I'm not necessarily a Graham and Dodd value guy, more of a Buffett valuing guy, where we're not trying to pick up cigar butts, but we want to buy fantastic companies run by great management teams and pay a fair price. And we call that our three pillars of investing. It's the three things we look for in every company we buy. And at the top of the slide, contrarian by nature, I just, it's inherent in me to not swim with the crowd. So when everyone's going one way, I want to go the other. That goes from everything from investing to picking the right line at the grocery store.
Although you did chase the dragon when you decided to go into small caps because it was hot back then.
Yes. Yeah. I mean, we all make mistakes, Ben.
Okay.
So just generally, I mean, the way in which the US equity market has worked so consistently in the last few years, Adam, is that your game, stock picking in small and mid cap, you can be a complete sort of slave to the earnings revision game, and you find your favorite value picks, which you love the look of the 2028 earnings growth profile, but if they're going to be having a couple of tough quarters, you've got the whole of Midtown Manhattan taking the other side of your bet. And how do you invest through that that dominant factor in the market, which is short-term earnings revisions?
Right. That's a great question. It's helpful to be stuck here in the middle of the country in Milwaukee. So I'm able to wall off a lot of the short-termism that's inherent in the markets. But we're of the mindset that things are cyclical, and knowing that we're in a cyclical market and you've got a diversified portfolio, we try to have a certain number of ideas that we're planting, a certain number of ideas that are growing, and then we're harvesting ideas from years ago, so that while we're always going to be, well, not always, but most of the time we're going to be early in a name where they are going to put up those bad quarters, where we're using time arbitrage to our advantage to say, hey, we know in a year or two this thing is going to be fantastic. And we can only have the patience with a certain number of names if the other names of the portfolio are currently working, because allocators don't have 3 or 5 years of patience. So we try to take patience with just one small bucket of our portfolio, so we can keep that flywheel running.
When you think about the quarters, right? Because I made the mistake of getting into small caps and realizing very quickly that it's not the same as trading mega cap options. And I got dunked on two. The Squirrel also was in the Goodyear tire with me, and then James Hardy, which our other classmate, got me in, and I was looking for housing plays. but like you really got to know what's going on because there's some vol in small cap earnings. Like you could have a 20 or 30% drop, like real easy.
Yeah, I mean, today in a portfolio of 30 stocks, it's earnings season, so we've got, I don't know, we had at least a half a dozen names report today. I had one stock, a grocery store, that was up 20%. And then I had a IP licensing company today that was down 20%. I didn't buy, I didn't sell, I didn't trim, I didn't add. You know, you just have to accept the volatility as a small cap investor.
And you're long only, right? You don't do
Long
long
only, 100% long only.
So my view on small caps is that they're long only. Like there's no shorting in small caps. It's just the worst convexity trade there is. I work with a guy who loves to smash the cigar butt, if you will. But it's easier to handle that vol if you like it and you're like, all right, it's just mark to market, right? Is that kind of the way you think about it? It's not price as much as it is. You're looking for something fundamental because the vol's intense, so you could get really tricked by that, right?
Yeah, I mean, you know, we are old school. So at the end of the day, whenever we have underwritten a company that's going through all the filings, talk to the management teams, you know, get market intelligence, talk to customers or suppliers, I think about it, you know, really as the PE guys, you know, would I want to buy this entire company? Now, I'm not going to do it with all the leverage they use. But would I, at the end of the day, if I want to own the company and I decide the answer is yes, I'm comfortable holding it for years because that's investors should think in years, not quarters. If you are a long-term investor. And so there is so much noise in the markets. And I think that's the toughest thing that investors have to deal with is, figuring out what noise you need to pay attention to. And that's why we've created a process that we think are the drivers of long-term value creation. And if we can just get those limited amount of factors correct, again, we can create value over the long term.
And I think that it's right. But I think that like we, again, since 20 plus years ago, the market structure's changed a lot, right? The rise of the passive, the rise of the pod shops, the rise of factor investing, which I remember we had to do a lot of research and create quantitative strategies in grad school and does it then translate to, hey, I'm long this and how do I position size it? Because I'm always curious about position sizing in a small cap portfolio because A, the vol, but then B, like a couple of them start to work. So, you know, say you have a few names that go like Carvana, like they use that as an example. In 22, it was like a couple $1 stock and now it's $400. Do you have to sell the winner of the convex portfolio of those names where they got, say, a 10 bagger so it doesn't get outsized? Or how do you think about that?
So the reason we run a focused portfolio is I think that is the easiest way to create alpha. If you know, why do people have large diversified portfolios of hundreds of stocks? I think it's just job safety, job security. When you have a stock portfolio of one stock, it's a standard deviation of 45 or 50%. If we're calling risk standard deviation, which again, I don't believe that's risk. A portfolio of stocks of 30 stocks has a standard deviation of about 21%. If you go to 100, it's 20. So like for all the extra 70 stocks, you're not lowering the volatility. So why not invest in your best 30 stocks? So the way we think about it is I cannot do a very good job saying next year, this sector is going to be the best performing sector. I mean, how many people started January 1st of 2026 and said, you know, we should really be levered to, you know, E&P, midstream, you know, anything energy related, that's where we should be overweight. Like
we were, just to be fair.
Other than you guys and long only small cap, very few. So we just try to we try to actually keep a pretty neutral weighting to our sectors, and then we'll let those sectors jump in overweight because we're picking stocks that are doing really, really well. And so we usually, in 30 stock portfolio, we usually size around 3. If we really like something, it's 4 or 5%, and then we let it grow. And as it grows to the high single digits, we just trim back. And so I think what's important for your listeners to focus on is the benchmark. The first strategy we created is a Russell 2500 value strategy. And we created it versus a Russell 2000 because the 2500 has only 500 more stocks. But the great thing about it is when a stock is 400 million, you don't have to sell it when it hits 15 billion because it has a much longer runway. And one of my big philosophies is hold on to your winners. A recent example, and it's a stock we don't own anymore, but we owned Sienna for years, probably over 5 years.
Stock. It's been a good stock.
Probably over 5 years. It might have been, we might have owned it for 7 years. It's only been a really, really good stock in the last year, because we bought it, maybe when it was a $5 billion stock. Today, it's probably 80 billion. But we were able to hold it.
I got shaken out of that one. I got into it in 23 as a sort of second derivative play on AI data centers, but one nasty drawdown kicked me out of it, and I never got back in.
And that's why you just have to, if your long-term thesis is sound, you just got to hold up. You got to hold on to the volatility. I think someone once said, and I didn't ever check the numbers, like Amazon, I think it had a 75% drawdown at one point, and it has multiple 30 and 40%
94.
drawdowns.
After the .com, it was a 94.
Yeah. So you have to underwrite companies and believe in their businesses with a lot of conviction in small caps.
Just to come back to, you like to ride the winners. Like, my biggest miss in my early career was Netflix. I got stuffed that at Fidelity as one of my, wide array of consumer stocks. And I would meet with Reed, and you could tell his streaming thing. And Will Danoff was all over my ass, even though it was only be 1 or 2 bips of his gigantic fund. And, it was like $1 billion then. And now it's a couple of hundred, and I wonder about like the cutting though, like, because aren't you then overweighting the things that aren't working? Do you have to is it just because of volatility? Like, hey, I can't have my one stock be 40% of my portfolio. Is that the driver of it, and just as a product, basically?
Yeah, it's most institutional investors and allocators just can't handle volatility. And they actually have restrictions in their IPSs as to how large one stock position can be. So we do end up putting handcuffs on ourselves because of what the market demands. If I didn't have those handcuffs, I would probably let the winners get larger than I do. But that's the world we live in.
Yeah, no, I get it. Total.
And for the record, I owned Netflix in grad school, and I was pitching it to you guys, and everyone said I was an idiot.
No, that's not true. We bought it for the equivalent of like 15 cents adjusted in 2004, but we got out of there by the time we graduated. So yeah, I remember that early Netflix. But yeah, that's funny. All right, let's get going. You have this some slides about being old and wearing shoes and dad shoes, and we'll talk to us about this.
Yeah, well, I think, back to the beginning that small caps have done really poorly over the last 15 years. I think a great analogy is comparing small caps to fashion, and how in fashion things are cool, then they're uncool, then they're cool, then they're uncool, then they're cool. And that's what we've seen in small cap versus large cap cycles. They're cool for 15, they're not cool for 15. So Princess Di, Steve Jobs, I think, hands down, people will say they were some of the coolest people back in the 90s. They're wearing dad shoes. Dad shoes then became uncool. I think jorts might be cool again now. But guy in the middle, back in the 2010s, he was not cool. And now, the women on the right, they are cool again. So I think perfect analogy comparing dad shoes to small caps.
So let me push back a little bit. I know you saw when we had Mike Green on in January, and his argument is that there's a secular trend as the weighting gets higher, right? Mm-hmm. And so that I hear what you're saying over a long enough time scale, but do you need that to end for the cyclical, or do you think it can end with that mechanical, let's just call it big get bigger dynamic?
So the Magnificent Seven today, I think, is worth 22 trillion. I believe the Magnificent Seven have a larger market cap than all the other developed markets outside the US combined. Can they become larger than the whole global economy? No. So I just think at some point the law of large numbers is going to kick in. And I think I had a chart showing when you get super concentration in large caps, Once that concentration hits a peak, that's when small caps start to outperform. So I think that's one way small caps can outperform is if the mega caps ever lose the mantle of relative performance. A tiny amount of money needs to trickle back into small from those mega caps for small to do really, really well. NVIDIA today is worth more than the entire Russell 2000. So if 10% of capital came out of NVIDIA and all of it went into the Russell 2000, the Russell 2000 would have a good year. Secondarily, at least as a value investor, tech has been, and thank you for that. These are the two slides I just referenced. There's NVIDIA in orange versus Russell 2000, and then blue is the concentration of the top 5 large caps over the last, I think, 40 or 50 years, and the orange line is the relative performance of small versus large. So you can see when there's a peak in concentration, once that starts to decline, small caps significantly outperformed, and it's happened 2 previous times. Again, it's not a data set that is statistically significant, but one I believe is hard to argue with.
The one thing I'd add to that, I have a chart going back a long way. There's a dollar component to it too. If you look at the dollar bull markets, they coincided with concentrated markets. In the late 90s, you had a really strong dollar. Basically, then we had a weak dollar for a while, and that's when small caps worked. And, we've had a really strong dollar for going over a decade now. And now it's a little wobbly, and the squirrel, thinks it's going to roll. And we've had a 10% plus, drawdown from the top. So is that in your mindset of like, hey, yes, there's these issues that are going on, but maybe it's just that everyone's overweight tech and all this stuff. And Mike Green argued that like really what it was is everyone just owned too much tech and they had to buy other stuff. So it wasn't even like they wanted small cap banks. It was just like they couldn't own anymore, and they just the canister was full. It had to go into other buckets basically.
I don't spend I try not to spend a lot of time on the macro because I probably don't get it right half the time. I'm surprised the market's doing as well as it is right now with the S&P hitting the all-time high today. If Warsh, follows his boss's directions and takes short-term rates to 1% in the next, 9 months, I would think that would create a weaker dollar. But I think a bigger driver too, outside of the dollar, for a headwind for small caps is the rise of private equity and private credit. I think that's probably bigger than the dollar. Historically, small caps, people wanted to go public. Now they don't have to, and so I think that has been a huge headwind. And I think combined with the headwind of advisors are allocating money to private credit and private equity. And so they're likely not taking capital from their fixed income bucket or their large cap growth bucket. They're taking it from other risk buckets like internet, like EM and small cap, and throwing it into private equity and private credit. So I think that's been a headwind that's going to dissipate. And then one other issue is that, and we touched on it, is that like tech has just been the place to be. And if there is a changing of the guards with what's going on in the Middle East, and people that make things and extract things from the environment actually are more valuable, that should be good for small caps.
Can we touch on that private equity point again? Because part of the frustration I hear from many portfolios, and I've experienced it myself, one of the big frustration at the time when the private equity boys were cashed up, the deep value small cap manager kept on getting taken out for a 30% premium when he felt that this thing had 3 or 4x to run, and the private equity guys saw the same thing. We're going to do the same thing with leverage. But given their propensity to overpay for software firms over the last 5 years, I'm not sure that they can play that roundabout game again. So maybe you're no longer short a call on some of your value plays in your portfolio. Do you think that's fair?
No, I definitely think it's fair. I my big beef with private capital is that obviously you don't have to mark to market, and I was the chairman of an endowment for a nonprofit in Milwaukee, and back in 2020 with COVID, we had a number of private investments, and it was a theater, and because the theater closed, we knew we weren't going to have ticket revenue, and so we have to de-risk, and so we're de-risking across the board, and to keep allocations the same, we were trying to de-risk from our private investments, and this was actually a private real estate fund, so commercial real estate fund. Maybe they owned apartments or office buildings, and we also had REITs, and the REITs were drawing down 30%. And the private real estate fund, mark to market, they were down like 1. And I'm like, it's all the same real estate. So they mark it down to 1. They only let you take out like 5% of your capital. And what irritates me is that they're feeding their customers on asset levels that are probably marked up 30% higher than they should be. I'm heartened by the fact that I do believe the asset flows into those markets are for sure slowing. And if they just reverse a little bit, I think money should flow back into public equities. And we are seeing a lot more interest from allocators in the small cap space.
Since when? When has that started?
In the last 4 to 6 months.
Okay, that's interesting. Maybe it is the year of small cap, Herbert. I hope so for you, Adam. Let's go to this slide right here to come back to the pain you dealt with.
Yeah. Feast your eyes on the very far right column, and that's the relative performance of the Russell 2000 less the S&P 500. And there's a lot of red. So the last year of any positivity was 2020, when small caps beat by 1.6%, and that all came in the fourth quarter with a monster 19% outperformance. But then you got to go back to, what was it, 2016, when I started my firm. I started Riverwater. Our first strategy launched September of 2016. So in the last 10 years, it's been very difficult to string together 2 consecutive quarters where small caps beat large. I think there was 1, maybe 2 in the last 10 years, which is, to me, just an incredible figure.
Anyone that believes in mean reversion, your time must be coming soon.
Well, again, I think it was a secular change. It was the keeping rates down. It was the rise of passive. It was the rise of private credit and private equity. And also, it's good you brought that up about IPOs. There were 7,000 stocks back in the 90s, right? Now we have like less than 3,000. And, with the private equity venture capital rise, the idea is that if you're small, it's because no one wanted to invest in you. And the guys who really had the growth opportunities are all incubated in the private markets first.
Right.
All the way to this atrocity that is the SpaceX IPO coming up.
Yeah, there's a few other very, very large IPOs coming up. So it'd be interesting to see how the market reacts and if it can accept that liquidity. The other thing that I would love to mention is we're talking about the Russell 2000. I don't run a Russell 2000 portfolio. I run a portfolio of 30 stocks that all make money. And going back to those time periods when there were 7,000 stocks, a much, much larger percentage of them were profitable. Today, I think 43% of the Russell 2000 doesn't make money. So it's a very difficult index sometimes.
We have that slide.
Yep, there you go. So,
and actually, I mean, it's a big number, even if you strip out the biotechs, which obviously never make money, right? Until that lottery ticket pays off. But the number's pretty staggering, even if you strip out the biotech factor as well.
Yeah, so it's very easy, I believe, over the long term to beat the Russell 2000, but it can be very painful in short time periods when you get a meme rally, you get a SPAC rally, you get a rally like last year post, I call it liquidation day, but I think we call it liberation day, where a lot of it is driven by retail investors, where you just get the GameStops of the world going to the moon, and that's not what we own. So we underperformed quite significantly last year because it was just a terrible rally. This year's been much better. And like I said, over the long term, we've got good numbers, but it can be very painful in short bursts, when unprofitable companies have very, very good performance.
Yeah, and some of it is mechanical from the pod shops, right? Those guys need funding shorts to own their longs, and they don't, a traditional long short fund that I would think of is like 60 long or 65 long and runs about 150 to 200 gross. Mm-hmm. Well, these guys are running 3 times gross or 300% gross, and they need to find shorts to go against their longs, right? And so you see, one of the things I've learned over the years is these small cap rallies are often the last, it's positioning. These guys, because they're so big, there's no one to take the other side. So you get these huge moves. Like I don't know, this Avis thing that just happened, the fastest Christmas tree of death ever. It goes from 90 to 850 to
I haven't
3 days, 150.
Yeah, what I haven't looked at Allbirds the last couple of days. I don't know if it's come back to earth, but a shoe company. A shoe company
that started as the dad shoe.
Right. Dad shoes. Popular. I think popular with the tech guys.
Yeah.
But it's the same management team that's now getting into AI. Like, these guys were shoe guys, and now they're AI experts. And the stock has a huge rally, burns everybody, and then comes back to earth. So that's the market we live in.
We used to see that a decade ago. When you remember when Bitcoin and crypto was getting big, and it was like our old pal Patrick Byrne of Overstock.com was like the T0 network, and then everyone's like, "Oh, I can do that." And then we get the headlines, which were like, an echo boom of we're a .com now. And then it just rips.
It was the Long Island Iced Tea Company, wasn't it?
Yes.
That was the perfect example of that one.
Yeah. So in small caps, it is a very dangerous place to play. I think you have to do it with eyes wide open. Have a strong stomach. Even when you underwrite names and know them very, very well, you just have to accept some volatility along the way. But over the long term, they have still outperformed large, and I'm a big history buff, and so I do think small caps will have their day again.
So let me ask you this, because this is your slide, and I looked at this data recently when I was looking at the S&P, and then I was looking at the contribution for the Russell, and like I mentioned before the show, Rupert highlighted in his last note, well, 37% of the EEM is AI. Mm-hmm. Well, now all this concentration in performance of the Russell is Bloom Energy, or I forgot what we said the number 2 was, Credo. Or something.
Credo.
Yeah. So you have a power law of small percentage, 10% of the stocks driving all the returns, all the earnings growth. So what does that say to you when you're talking about concentration for large cap? Maybe it's not a size thing. Maybe it's what industry you're in, and that's just what people want.
Right. So we're a value shop. I think we did a decent job identifying that AI is not a fad. There are still some faculty at our alma mater that thinks it's a fad. In the way in small cap to play it, we say it's picks and shovels. So we identified electricity as a need. We're playing that from small caps that supply transmission lines with equipment that actually still has no Wall Street coverage. Like, it's a $1.7 billion company and no one's paying attention. But the stock is doing well, so I don't care if it doesn't have Wall Street coverage. We bought electrical contractors. We bought Sienna. So we are playing AI, I believe, from a value guys perch. And the big question we ask ourselves every day is, when is the party going to end? And so I think about that every single day. But when you're running a small cap concentrated portfolio and you got the Bloom Energies of the world, really what you have to, it's kind of like venture capital. Like in venture capital, like 1 or 2 of your investments are going to produce a lot of your performance. And that's what we've seen historically is we get like of our top 5 holdings in a year, those you're usually driving most of our returns. And I honestly couldn't tell you what the top 5 are going to be on January 1st. We just have to, again, buy 30 stocks and hope, 5 of the horses are just going to, gallop away.
And so, I guess there's not such thing as normal times, but we're in a historic CapEx cycle right now. I made a website on Claude today that showed the top 5 hyperscalers, what their nominal numbers are all the way to the estimates, which, we got a lot of estimates last night with all that. And then as a percentage of GDP, well, those 5 went from 0.6% of GDP in 23 to almost, based on the estimates of the guides that were given last night, and I guess Oracle had like to 2.4%. So you had an incremental 180 bips over 3 years from this. And if you added all the big CapEx projects up together, I saw some slide that this is what got me thinking to do this, except for the railroads, it's greater than all of them combined. Like .com, the Public Works, etc.
Yeah, the interstate highway system in the 50s. Big things that made the world a better place. And I use Claude, but I did the same thing you did. I'm like, compare this boom to all the other booms as a percent of GDP. And railroads even had a number of booms and busts. That's why I do think we're going to have a bust. I mean, Sienna, if you pull up a chart of Sienna, in 1999, it was a moonshot. And then we had dark fiber, like 90% of the fiber that was built out got unused. So, there's a lot of compute that's needed, but it's technology. And will someone, like a DeepSeek moment, will someone figure out a way to make things more efficient where you don't need all this capital? And then the other thing that terrifies me of the data centers, maybe you guys know, is like 30% NVIDIA. I don't know, of the CapEx of a data center, a large chunk of it, are $36,000 chips, which at the front end, they only last like 2 or 3 years. So like a railway, you can depreciate over 30 years and it might last 50, and a highway will last more than 3. And so the depreciation on these things is so fast. I even saw that the hyperscalers are starting to cheat with their depreciation schedules, and they're making it longer and longer. So it's like at some point or maybe Elon figures out how to put servers in space where you don't have to spend money on cooling them. We own Modine. We own Modine, which is was a underperforming industrial company based in Racine, Wisconsin, forever. And because it's in our backyard, I'm like, we just have to pay attention to it. And I remember when it was like $5 and they got a new CEO who is fantastic. I'm like, we should take a look at these guys. And so we drove down and we met with him, and he's up on the whiteboard going nuts. And I love guys in whiteboards going nuts because it showed the passion he had for this industrial business that went nowhere forever. And we didn't think about AI when we bought it, but what do these guys? They make chillers, and they had a rolling stock business and had Class 8 trucks, and they've now cleaved that off, and it is a data center company. And the stock went from 5 to wherever it is today, 150, so
that's a good one.
Yeah. And so that drove our performance, I think, in either 24 or 25. Then we get Sienna last year, and this year we do have some stocks that are doing really well. So again, it's that venture capital mindset where you got, focus group of 30 stocks. Who's gonna be your horse for the year? I don't know, but likely the AI train isn't going to end this year. It's probably going to go at least through 27, maybe 28, but the stock market discounts things probably 6 months in advance. So, do you have to start, jumping ship in mid 27? Maybe. But the way we think about it is, again, back to how we manage portfolios, is as the stocks become larger percentage of the portfolio, if it's 7-8%, we'll just trim the position size back, get all our money back from the original investment, and then
let it run.
So
Can I pause you? This is, I don't think I've ever met a value or a small cap or mid cap manager that hasn't really indexed on knowing the management and believing in the management. And you've already said it there. There is this school of thought that CEOs are fantastic salespeople. And
they're big liars too.
And that getting too close to management teams can get you stuck in stocks for way too long. You can overstay your welcome. You can be charmed by management teams, which sometimes can cloud objectivity. I mean, I could argue both sides of the coin, to be honest.
I could argue both sides as well. I spoke to a CEO today, and everyone's bullish on their business. So you have to take everything they say with a grain of salt. And I don't meet with management teams to tell me how great the business is. I meet with management teams to explain to me how they think about the business, allocating capital, how they think about what their capital structure should look like. So I meet with management teams because I get a better understanding of how they think. And I think Warren Buffett said it well. And again, we've 3 pillars. We want to own great businesses with fantastic management teams and pay a fair price. You could have the best management team in the world. If they're running a shitty business, it's not going to be a great long-term investment. And the analogy is, if you put the best jockey at the Kentucky Derby tomorrow and you put him on a donkey, it doesn't matter. He's the best jockey. He's on a donkey. So at the end of the day, we need to pay a lot of attention to the business, and we focus on return on capital, because if you're not generating returns on your capital, that limits your growth. If you have a 6% return on capital, there's no way over the long term you can grow 20%. You just can't do it. But if you have 30% returns on capital, you can easily grow 20% for a long, long time. So we just want to stock back. Right. We just want to own businesses that have, it's the castle with the moat and then a wall around them. So that's first and foremost and the CEO can't lie to me about the numbers. I mean, they can.
Just staying with sort of management and management alignment and compensation. Mm-hmm. Do you find yourself getting involved with comp plans? I'm very wary of comp plans that are linked to share prices generally, because I think that that ultimately clouds decision-making process for the processes that can impact the longer-term value of businesses. But do you get stuck in the weeds on that? Are there comp plans that you try and avoid?
Yeah, we get stuck in the weeds with anything that gets filed. So whether it's proxy statements, 8Ks, Qs, Ks, we're reading everything. And we do spend a lot of time on management teams, and incentives are what, in my beliefs, incentives drive people. So we love to invest in businesses that are founder-led still, and have large insider ownership, because that's the easiest way for us to all be aligned is that you just own stock outright. If not, we want to see that CEOs and senior leaders have at least 5 times of stock of what their base salary is. And when we're looking at comp plans, you've got the annual plans and then the long-term plans. We are active investors. We're not activists. So we give our opinions, and we don't file 13Ds. And what we tell every single management team on long-term plans, there has to be some type of ROIC involved, because again, that's what drives long-term value. So that's the one thing we always want, is a ROIC feature in the long-term plan. The short-term plan, I'm fine if you measure it to EBITDA or sales. But that's basically what we look for.
Okay, my other bugbear, is just in terms, it's not so much of a problem in mid-cap space, but it's becoming prevalent across the market. But adjusted EBITDA metrics, adjusted GAAP metrics, etc. How much sort of tolerance for that do you have? The trouble is, it's totally infected the sell side. So the sell side model the adjusted KPIs, right? You can't find model numbers for GAAP accounts. And, as Ben and I have talked about this a couple of times on the show recently, one of the big tells for the end of the cycle is when, GAAP and adjusted numbers the jaws start broadening. I mean, I guess it's less of an issue in sort of, real world businesses in the Midwest versus some of the stuff we've seen on the West Coast. But, how do you get around that?
I like to say we look at valuation 6 ways to Sunday. And so we look at different valuation metrics depending on the industry. Obviously, for banks, I'm looking at different metrics than if I'm looking at a healthcare company or consumer discretionary. But if there's only, if you said there's only one valuation metric you can look at, it's free cash flow and free cash flow yield, whether it's to equity or to enterprise value. Because again, everyone's messing with their GAAP numbers. So I pay a lot more attention to, and the only metric that pays the bills and covers your need to reinvest into capital that generates cash flow is free cash flow. So that's the figure that I pay the most attention to, because but
free cash flow gets adjusted so much as well. I mean, so you adding back stock-based comp, what are you doing with that? What are you doing with your, or deducting stock-based comp rather?
Yeah, I mean, it depends on how you're thinking about the denominator. Is it fully diluted or not diluted? When we look at comp, I obviously prefer less stock-based comp than more. I would just rather have people be paid in cash, and then if they want to buy stock, they can buy stock. I get that there's a whole tax avoidance thing going on, but we prefer less than 2% stock-based comp dilution every year. And but that's outside of the fact that I hope the companies I'm buying are generating free cash. And it's again, the biggest job of a CEO is capital allocation in small cap land. I like to say, if you or Ben were plopped into the CEO seat in Atlanta to run Coca-Cola tomorrow, I'll bet you any amount of money that you guys are not going to bank Coca-Cola in the next 2 to 3 years. Like Coca-Cola will be around in 2 to 3, and you guys are running it. And I don't think you have any experience running a cola company, a global cola company. Zero. If I put you in charge of
every country in the world, one of 2 companies, that is a hell of a flow chart. You remember our operations class in grad school? I hated that class. That is a big one. That is like understanding the logistics of Coca-Cola.
Right. But if I put you in charge of most of the companies we own in our portfolio, I bet you could bankrupt the company, because you could just say, hey, look, I'm going to make my comp based on sales and EBITDA. It's a P&L only metric. I'm going to go to my bank down the street and get $1 billion loan to go buy another company. And I just increased my EBITDA and my sales by 50%. And now I get this big stock bonus. And then I get fired a year. I don't care, because I made my fortune.
Benny would buy a jet.
You mean what private equity guys do? Like basically that's their business model, right?
Yeah, and I always say I'm an idiot for not going into private equity 20 years ago, because we're doing the same thing. We're doing the same thing.
That is actually true, buddy.
Yeah, I mean
exactly the same job for worse comp.
Right. So we charge a ridiculously low fee too. Well,
that's good. The truth is, small caps are an area that have less and less people looking at them, and having not a crazy fee, because most guys are going to do it. They're going to go to a hedge fund model. They're going to say, I'm going to spend the time. I want to get paid. Right. I'm going to go down to Racine, and I'm going to find a stock that's a 50 bagger or whatever you said it was, or 30 bagger. Like, I want to get paid for that. You know what I mean? Like that requires work. Like Rupert might, he owns Uzbeki stocks and weird stuff like that. But that's the mentality of guys. They're like, if I'm going to do the work and take on the liquidity and volatility of it, I want to be paid versus give people access. So it's not surprising that you had success with your fund, because, people need some allocations to different stuff. But going back to what I had before, the last time we saw a divergence between trailing and forward earnings in the Russell, and again, I know Russell, we talked about the problems, was when you started your career as a small cap manager, which was not a great time after that. What do you account for this? Is this all AI basically? Or, what is accounting for this massive divergence between trailing and forward?
I think you hit it. I think it's AI. Sky's the limit with AI, and so, and it is big numbers. I mean, you saw CapEx from at least Google, AWS, and Meta. What did they raise their CapEx? The three of them combined raised their CapEx numbers by what, 50 billion?
Yeah, and it's got to go somewhere, right? It's circular.
Right.
Okay.
So it's going down to a lot of small cap companies that are building out these data centers, and
so let's talk about bets that you've currently got on, Adam. In terms of the AI theme, what percent of the current book is that? And we talked a little bit about energy. How are you placing your sector bets in Q2 26 right now?
Yeah, I would actually say we're probably 20% exposed to AI through picks and shovels. That's mostly in industrial and tech. In energy, the most interesting thing in energy is we're a responsible investment shop, which I don't think I forgot to mention, but that's a huge differentiator for us. So our philosophy is we don't want to invest in industries that make the world a worse place. And it's mostly your typical sin stocks. Like, does tobacco make the world better or worse? I'll argue tobacco makes the world worse. But a big point of differentiating for us versus other responsible investors is energy. A lot of people want fossil fuel free funds. And I actually think we can make the world a better place by investing in energy companies. And we can
love that.
We can give them advice on how they can drill the same barrel of oil and do it with a smaller environmental footprint. And that's better for everybody. And so oftentimes when I talk to people who don't want to invest in energy, and there's other reasons that we can get into why we invest in energy. One of them is 2026. The other one is 2022. I mean, you're putting your portfolio at significant risk if you don't own energy stocks, in my opinion. But I say, all right, so you're divesting of energy from your portfolio. That's your prerogative. Are you divesting of energy from your life?
That's a good line.
So if you're not divesting it from your life, why are you divesting it from your portfolio? Like, please be philosophically consistent with this.
Yeah. So let's talk about this Cushman Wakefield, because I had a group chat with our friend Matt Kelly and another guy that I work with, where the title of the group was Short CWK. Now, this was started in 2022, and I don't have an opinion on it now. Tell us why you like it.
Yeah, this really came out of the AI freight train fear trade of February, when every day or two Claude came out with something new that was going to destroy an industry. Right. So trying to think of all the industries it destroyed.
There was a lot. Yes,
there was a lot of industries. But one of those industries
it was one a day for about a week.
Yeah. I'm like, oh, the stock is down 9% today. Why is that? I'm like, oh, Claude is going to destroy it. And so we did a large deep dive into software in February, because I couldn't own software for the last 15 or 20 years because I'm a value guy. But when software names start having double-digit free cash flow yields, I'm like, maybe there's a diamond in the rough of all this garbage. And garbage is from a valuation perspective, quotes. There's a lot of high quality software companies, and that's why PE got into them in such a big way. And so we've identified security and software companies that have a regulatory moat as probably surviving. Ben's newer group is not Cushman and Wakefield, but it's FactSet, and I do think FactSet probably has large headwinds because of AI. But it swept through the brokers, and as we were looking, and we were getting defensive in February, March. So if you look at Cushman and Wakefield, it's like a dead man's heartbeat for the last 10 years. I mean, the stock really hasn't done anything. But what piqued my interest is free cash flow is now inflecting. And so Cushman and Wakefield this year has a double-digit free cash flow yield. And over 50% of their business is managing properties. So is AI going to take over property management? Today, tomorrow, next year, in 2028? No. Will AI take over property management in 2040? Maybe. I mean, the point where robots
last time I checked, Claude couldn't unblock a toilet.
Right. So if over half their business is property management, I feel like the business is gonna be around. It's trading at a single digit PE. Historically, it hasn't had a great PE because it's had a lower return on capital than its competitive set like Jones Lang LaSalle, Colliers, and the other large global brokers. But when it's a single digit PE, and if you can go from single digit to 12 times earnings, you can get a lot of alpha just in multiple expansion. So we just need it to go back to its historical valuations. It's gonna generate $800 million of free cash flow in the next couple of years, so they could opportunistically buy back stock to juice earnings. And again, it's been a dead man heartbeat. So if the world ends, I feel like the downside, we're not gonna have a lot of downside capture with the name. And so, yeah, will AI kill? Is the terminal value of a lot of industries, is it going down because of AI? Yes. But the terminal value for AI taking over property management that's like a 2040, 2050, thing in my head, and I'm not looking out that far.
Kush, let me ask you this because I haven't paid attention to it in a while. One of the things we thought was they'd just taken out a bunch of leverage, and it was clear to me because I have buddies who work in commercial real estate that guys were going to do the kick the can thing. They're going to be like, well, Fed's going to have to cut rates soon enough. Mm-hmm. And now we're seeing I follow a guy on Twitter who every commercial real estate deal there is, he posts on there. I mean, they're clearing the house right now. There's some distressed debt buying or distressed buying, banks are dumping it. All that kicking the can stuff's over. So, how's the leverage, and do you think volumes will start to pick up as, we've cleared the deck more or less?
Yeah, I think, office has been terrible. I mean, and I think it was just recently a front page news story in the Wall Street Journal that, $500 million properties are going for $5 or $10 million now. So but I think that's all priced in. And then I do believe maybe 10% of their business is now data center related. So that should be offsetting a lot of the office headwinds. Leverage, it's not a pristine balance sheet. But it's in my eyes appropriately levered. I think it's got a 2 handle on debt to EBITDA, and that can come down again significantly with $800 million of free cash over the next 2 years. So the balance sheet doesn't keep me up at night.
All right, let's move to this one.
Yeah, Limoneira. You could say I've been wrong for the last few years, and you could say, yeah, maybe this is a value trap. But the company's been around since I think it was 1882, maybe 1888. I mean, how many businesses do you know have been around that long? So if you can be around that long, it's a decent business. And Limoneira, like the name sounds, has been in the lemon business. So we bought this a few years ago at around the stock price that it's at today. So it's at 12, 13.
Is it structured as business because it's not structured as a REIT? So
no,
some of these fruit farmers thinking of Gladstone Land and other things like that.
It's a C corp.
Fruit tree crop plays. Yeah, this is a proper C corp.
It's a C corp, and we actually had a double in the stock and didn't sell a share because they announced strategic alternatives because the board realized that the inherent value was not being realized in the public markets. They didn't find a buyer for the whole company. I think they got offers somewhere in the 20s, but I thought the stock was worth somewhere in the 30s, maybe even 40s, and so that's why we didn't trim as it doubled. It's now come back because they canceled the strategic alternatives process. But a good analogy of our portfolio. I'm fine holding on to, and we have very few deep value plays in the portfolio because we're more relative value investors. But this is probably one of the premier deep value plays we own, and the thesis is they own a lot of land.
So what are the numbers? What are the free cash flow yield numbers? What a headline?
Yeah, these guys aren't generating a lot of free cash. It's a net asset value play in the land, the water rights, and the non-core assets that they own. So the market cap today is about $320 million. I think when you sum it all up, it's probably worth $800+ million. They've got a real estate partnership with the Lewis Group, where they're developing homes, and Lennar bought a chunk of homes, and it's in a home constrained market in Southern California. So that contract will actually pull in over 100 million of cash over the next few years. They've got water rights that they're currently attempting to monetize that should pull in at least 50 million. They got a winery that they just sold. They just pulled in 10 million of cash, and they're still going to own a chunk of the winery. So they got you combine all that, it's equal to the current market cap of the company. And then they own 800. They've had 800 acres of avocados that are of lemons that they're transitioning to avocados. Avocados are a much better crop than lemons. And so lemons have been a terrible business since COVID. That basically are EBITDA break even. By moving to avocados, they should generate 30 million of additional EBITDA, I think, by 2028. And so if you throw on just any decent multiple onto that 30 million of EBITDA, if you say it's worth 5 times, it's 150 million. If you say it's worth 10, it's worth 300 million, which is, again, the current market cap. So you put the avocado business worth the current market cap plus all the other stuff I talked about is double the market cap. And then they own a large chunk of land in the middle of Ventura County that they're going to entitle. And I just toured the land with the CEO in March. And I believe, again, that plot of land will be worth the entire value of the company. It's not going to happen for 5, 6, 7, 8 years. But if they can get avocados moving, if they can monetize some of the non-core assets, I think it can do very well. And as a corollary, you should look at a company called Alico, which is in Florida. The ticker symbol is ALCO.
I know that one. This is
right.
the orange plantation.
Right. So we own that one too. I like crops for some reason. They've now gotten out of the orange business, and now they're just going to monetize the land. And so I think if you look at what that stock has done, there's no reason that Limoneira can't do the same thing.
So when life gives you lemons, sell avocado toast to Zoomers.
Exactly.
That reminds me of a question I was going to ask you, Adam, because I love that hidden assets. It's fun having this conversation. We talk, especially this year, we've talked so much macro. And so, with right now, there's a little bit of a break in the macro. We got earnings. It's fun to talk stocks again. And, this isn't stuff why I liked it. Why I went to Fidelity, like, hey, let's go through this. Do you do special situations? Because I think about all the money I've made in small caps, and almost all of it is in special sits. Now, that's how my brain might work, but there's a lot of special sit things that can be done, right? New management team,
maybe a function,
Russell 2000, hidden asset of a lemon farm or avocado farm or whatever, and who's paying attention to any of that stuff, right?
Maybe a function of your patience, Ben. This is.
I think that's it, because we make more money holding on to things for years, but. Again, it's hard to resist the temptation of things that are trading at 50% of where they should be trading. And we bought Leggett & Platt in the fourth quarter, I think. And if anyone owns a bed, there's like a 50% chance that it has Leggett & Platt parts in it. They've made the steel springs. They've gotten in the supporting foam. And it was a fantastic business for a long, long time. And then management team allocated capital improperly, and the stock went from like 60 to single digits. So we started nosing around, and they received an unsolicited offer from Somni Group, which is the Tempur Sealy, new name for Tempur Sealy. Tempur Sealy is a fantastic business because the government let them create a monopoly, which the government, sometimes the government cares about monopolies, and a lot of times they don't.
Not anymore. That's the whole thing. That's not how things. I don't know if you know this company called Apple.
So Somni Group, bought Mattress Firm. They're the 800-pound gorilla, and they made an unsolicited offer for Leggett & Platt, which means they're going to own the entire vertical business, everything from the steel to the steel becoming the springs, to it becoming a mattress, to where the mattress gets sold. They're going to own it all. And so we thought this was a highly attractive asset for Somni Group. So we bought it. And then we're like, they started talking. I'm like, they're stealing this company, Somni Group. But I'm like, there's no way Somni Group, or there's no way Leggett & Platt is not going to do this deal just because they've done a terrible job, and they should just get a slightly higher price. So I'm like, yeah, we'll take, if we can get a 30% premium. So that did happen, but it was a stock deal. And we're like, we can, instead of buying Somni Group at 25 or 30 times earnings, we're buying Somni Group at 8 times earnings or 10 times earnings. So we're buying the 800-pound gorilla that has monopoly in the mattress business for 8 times earnings. Like, when else can you buy a monopoly that cheap? So that's the most recent example of a special set that we've done.
How long did you have to wait for that?
It wasn't long at all. It was a matter of months.
Yeah, nice.
And last thing we're going to talk about.
I saw a whole load of stuff about aluminium in your.
Yeah,
deck.
here we go. That's what I was going to. We're not going to let you off with without talking a little macro. And now this is fed into Notebook LM from your writing, so we're not forcing you. You did write about this in your last quarterly note, which I guess, how can you not talk about the war? Walk us through this.
Yeah, I think I slept, what's 4 times 30? Like that's the number of hours I slept in March, just trying to suck in all the all the news flow. And text
from me.
Right, text from you at all hours of the day. So we're trying, we have to own stocks in every industry. So we own material stocks, and energy stocks. Energy, I wasn't as attracted to because energy always spikes and then it comes back down. But aluminum caught my eye, and I was talking about it with another really smart guy the day or two before, the power went out for EGA. And we're like, yeah, we should really start deep diving on steel and aluminum because so much is coming out of the Middle East that if it stops, the market's going to change. And then lo and behold, EGA, the power goes out and the pot lines freeze. And the difference between aluminum and oil is when the pot lines freeze, nothing's coming back. If the Gulf opens up, it's not like aluminum's coming back. It should take a long time for that capacity to come back. So if I'm going to have to own material stocks, while they're not fantastic long-term investments, I think there's a lot of upside in the small number of aluminum publicly traded investments in America, and so we took a position in one of them, and the government is interested in the U.S. producing more aluminum, so they're making that happen. So I think that your chart showed we went from 32 smelters to 4. There's only 4 smelters now of aluminum in the entire U.S. We're importing it, and like the idea of you want cleaner industries. Well, you're not making the world cleaner by moving aluminum production from the U.S. to anywhere else in the world. It's probably worse because they're environmental.
I love the aluminum trade. I'm not going to take credit for this. My good friends Kevin Muir and Chase Taylor got me excited and got me into Alcoa in Q4 last year. Mm-hmm. It's been a great trade, and then Hormuz is just cherry on the cake for the industry structure because the Chinese were already cutting back their capacity. It was going to become more localized. With the whole reshoring effort, it was a no-brainer. Right. Love it. So what are the small and mid and value plays in? There are not
a lot of opportunities. So if you ask Claude, you'll figure it out really quickly. Century Aluminum is one of the handful.
I remember that name.
It's a smelter. They've got operations in the mid-con of the U.S. They're expanding capacity with EGA as a partner. So that'll come online. You can't look at valuation, look at PEs for cyclicals is a very, very dangerous business.
Yes, it is.
I'll tell you,
they always look cheap at the top. They always look cheap.
I'll tell you, it's 5 times earnings, and you should be like, I don't want any cyclical trading at 5 times earnings. I want cyclicals at 70 times earnings. So we're cognizant of that. But to me, it's more of a long-term play. Boeing's just been a complete disaster for a long time. I do believe 737 build rates are going to go higher than 38 a month. That's a driver. We're looking at another aluminum name that has beverage exposure. I think that's a stable business. And then in the auto market, actually the move from EV to ICE vehicles can benefit the aluminum auto suppliers. So there are a number, I think, catalysts from the demand side in aluminum in the U.S.
It's funny you mentioned Boeing. That's another special sit I did. I was waiting for that recap forever. Participated in the recap, bought it in the aftermarket. I looked it up. It's $228, not bad. It's no Bloom Energy, but for a company that was just a massive dog and maybe the most important company in America for a long time, at least it seems like it's gotten its act together a little bit.
I hope.
Agreed. Okay, so let's. I think we're about time here. I wanted to add to your last little slide that I thought was cute. You can give your pitch on small caps one last time, and then let everyone know where they can find you if they're interested in your fund or your writing, etc.
Yeah. So before I forget, riverwaterpartners.com. We've got all of our writings there. I'm on LinkedIn too. I don't know what, I guess Adam Peck. You can find me. Being a contrarian.
Go to your fund's website, invest in his fund.
Yeah.
Some small caps.
Being a contrarian is hard. But that's how you make the money in the long run. So, think small for big returns.
Yeah. Well,
I'm going to be digging in. Because you've been a small cap value guy for 20 years.
Yeah. Well, I'm going to be digging into avocado economics for sure, for one. Adam, thanks so much for joining us.
Thanks, guys. It's been a pleasure. Good to see you.
Thanks, buddy. It was great.
Thank you.
Bye.